It looks like the sluggish US economy is on the mend. Job growth roared back in June, with the US economy adding almost 5 million jobs after a historic plunge in April. Meantime, unemployment continued to trend downwards.
It's still hard to really interpret what these job gains mean. And the reality is that most corporates, in order to qualify for the aid from the fiscal package, they need to show that they've maintained 90% of their workers. And so a lot of these workers had previously been laid off, but they need to get put back onto the payrolls by the end of the month in order to qualify for the grants. How much of this job gain is a true improvement in the economy, and how much is it corporates just trying to qualify for fiscal packages?
Economists at Goldman Sachs now think that the US economy will contract by 4.6% this year, worse than previously thought. This after some states imposed fresh restrictions to contain the COVID-19 outbreak.
We absolutely have a second wave of infections in the United States, and that second wave has already greatly exceeded the peak of the first wave. A second wave will derail economic recovery. These second waves have emerged as a result of gradual reopening of economies and societies. That simply tells you that this virus is very difficult to eliminate, and elimination of this virus will be economically costly.
Despite the grim reality on Main Street, US stocks have rallied strongly since their March lows. Wall Street stocks recorded the best quarter in more than 2 decades in the 3 months ending June. Markets are not only driven by fundamentals like how well the economy is doing, but also by liquidity. The amount of fiscal and central bank stimulus has been unprecedented and has lent support to this rally.
This is the second highest level ever seen in the US stock market, except for a brief period from October of last year to February of this year. Yet we are in the midst of the worst recession since the Great Depression. So at the index level, you've got to say it's not properly priced the problems we are facing. What will be required to see us retest the year lows would be a series of bad news with regards to the vaccine and with regards to corporate bankruptcies. There's clearly a disconnect between the suffering on Main Street and the bullishness on Wall Street.
I still think the gap between Main Street and Wall Street is about as big as I've ever seen in my life. It's still such a large gap that I find most of our clients are very confused. How could it be that the economy looks like it's declining by 30% and yet markets just rallied 20%? This doesn't make sense.
Another explanation for the exuberance on Wall Street could be because investors are looking ahead to when the economy starts to pick up. Investors are expecting an uptick in both economic growth and earnings performance. Markets tend to be leading indicators of the economy.
If you have an expectation of a recovery in the second half of 2021, then that's roughly a year to 18 months away. That means the current prices should be roughly just the discount at the cost of equity compared to that. Another way of saying it is, if you're going to hold equities for a year, what's a reasonable level of return expectation? And usually that number is around 7 to 10%. You're thinking you're trying to work back from the recovery point. Markets should be 7 to 10% below where they were on a pre-COVID crisis level. And that's roughly where they are right now. So the difference between where the economy is right now and the markets is really still very large. But overall, if you do eventually expect a recovery, then actually markets are sort of behaving in a more logical fashion.
Investors have sort of discounted 2020. They are looking to 2021, 2022. They're taking a longer term view. Interest rates are extremely low. Not a great deal of opportunities in many asset classes. Equities do offer promising upside in the next 2-3 years. So there are bargain hunters looking to buy.
Some analysts say there are more worrying reasons for the market rally. One of these is the potential collapse of the US dollar.
5 to 6 years, the US dollar is going to deteriorate as a result of that. Over the long term, the US dollar is going to deteriorate in value. You'd want to spend that US dollar, you'd want to see it in hard assets, or you want to see it in stocks. So that's what's driving the rally at the moment. It's one form of fear. It's fear of the devaluation of the US dollar.
Against a backdrop of uncertainty, analysts say the next few months will be choppy for the markets, and investors should tread cautiously and not be carried away by sharp rallies or pullbacks.
I think the 1 to 2 years is going to be a very uncertain period for the markets. COVID-19 is one headwind, US-China tension another headwind, essentially domestic US politics other headwinds. While we are slightly more positive on some asset classes, it's important for investors to diversify, have some representation of equities, bonds in their portfolio, and gold as well, because gold is a useful hedge against risk and uncertainty that lies ahead. Now, the other element of diversification the investor should also pursue is time diversification. So in other words, to spread your investments out gradually over the next perhaps 6 months, 12 months, keep some dry powder.
The equity rally we think is more sustainable than most people expect, but our view overall is that we're neutral on our positions of equities. Therefore, we think it's justified, but we're not really chasing it that much more from here. We have our biggest overweight in credit, so especially Asian credits are our top overweights, and we think that that's kind of an area where we think you can make returns without taking all the volatility that you get with equities, and that's our sort of top recommendation to investors. We do have an overweight in gold, and we're a bit more cautious on things like government bonds with bond yields so low.